Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome back to Sparta Market Outlook Podcast, so your trusted source for real-time insights into the global energy and commodities landscape. I'm Rachel Williams, your host, and today we're diving into one of the most complex and volatile periods we've seen in a while across the oil barrel. From futures curves flexing their muscles to geopolitical chess games influencing flat price, we've got a lot to unpack today. So whether you're trading the front end, watching for policy signals, or simply trying to make sense of no-see spreads, you're in the right place. So let's get into it. So why don't we jump into what new things we've learned this week? So let's start with what's going on with flat price. There's clearly a lot of noise. Do we think that this is headline driven, or is there an underlying structural shift happening? Neil, I think this one's over to you.
Yep, sure. Absolutely. It's absolutely headline driven. I don't think we can really take anything seriously from the flat price at the moment. Well, there's all kinds of things going on, right? I mean, it's just following to a certain extent the equities and the wider sort of financial markets, and there's been a lot of flip-flopping. So, I mean, even over the last 24 hours, there was a bit of a relief rally, so to speak, forming up with hopes that there would be some kind of tariff reprieve or some kind of deal in the making. But then Scott Bessent came out and said that it's not going to be unilaterally from the US side and blah, blah, blah. So it's really purely headline driven. And then there's the whole situation going on with the Fed and Jerome Powell. Yeah. And that's also the US dollar has been a complete mess this week as well. And then, of course, yesterday there was the news from the Kazakhstan energy minister, which basically, well, how do I put it? It kind of was an admission, if you like, that they could do very little about their supply level because, as we've known for a long time, it's international companies who are partly producing Kazakhstani oil, and that just puts the whole OPEC cohesion kind of thing in doubt. And I was actually just writing an article yesterday saying that flat price doesn't really, I was going to say spreads didn't really make that much sense. And then just as I was about to publish, the flat price fell by like $3 just on this headline, and it's just ridiculous. There's no point even writing anything. Anyways, totally headline driven, let's say, from a flat price perspective. Is that fair, guys?
Yeah, I think I can't see anything wrong with that. I think on the Kazakhstani news, I remember there was a table a couple of weeks back with the kind of the compensation cuts out of OPEC Plus, and Kazakhstan was supposed to be one of the really big ones there, right?
Yes, they're the sort of chronic overproducers, and particularly in sort of Q1, it's even worse because they expanded some of their fields basically. So now there's even more pressure to somehow sort this out. I don't know how it's going to go on, but obviously it's going to be worth a bit of pain in the sort of sentiment of the whole thing over the next while.
Yeah, so that could be a bit troublesome then if they don't cut or ramp up. Okay, time spreads. Time spreads have been quite interesting in crude as well.
Yeah, I mean, in fairness, spreads are pretty strong all over the place, but it's the sort of time spreads which I guess make less sense to me, and we can talk about that in the crude segment. But I mean, what I was trying to write about yesterday was the fact that you've got ICE Brent spreads. Well, they're down a bit today, but they're approaching $1 per barrel at the prompt, and it's a very prompt issue. And I'm not quite sure why that is. I think it's partly it's specifically a Brent-related thing, and that's why you have TI Brent that's kind of wide, and you've got the EFS which has rallied quite a lot. I don't know if it's fundamentally driven. It's obviously one of the things we don't know. We can only try and comment on whether it looks like an outlier or not from a Arb perspective, let's say. And on that front, it does. So like physical North Sea looks unsustainably strong. And it, for example, 40s is definitely an outlier in terms of FOB premiums, globally speaking. So,
what did you pick up in the crude side?
Yeah, I mean, it could be fundamentally driven. I would say that you guys can pick it up. The product market looks tight, right? Almost everywhere you look.
Yeah.
Do you guys want to pick that one up briefly?
Yeah, well, so obviously, I mean, EBOB rallied a little bit and it's come off today, but what's kept going actually is in the East as well. I mean, obviously, we were talking about maybe crude is a Brent-related thing, but yeah, on gasoline, we're seeing spreads rallying pretty strongly. HSFO looks very strong at the moment. It's a kind of, obviously, it's a time of year for that, but all of our metrics are making it look as though it's a bit too strong, a bit too kind of not necessarily justifiable, but maybe there's something going on there to justify it, but we don't see it just yet.
Okay, we can pick up on that kind of in the product side.
Look at stocks, for example. So one of the most visible inventory data, or the most visible pieces of inventory data, comes from the US, of course.
Yeah.
And as of yesterday, post data release from the DOE, everything looks really tight. Year-on-year perspective, seasonal perspective. Commercial crude plus products is down 25 million barrels year on year, something like that. PAD 1 diesel stocks are really low. There's nothing really out of the US that looks loose. You can talk about crude builds, but that's what happens over Q1, right? That's just one of these seasonal things. So yeah, it looks good. And one thing I wanted to pick up on just in this intro was, it's interesting thinking about the forward demand perspective, right? So when you get a big jump lower in flat price, you tend to sort of entice consumers to do a few different things. And it's just a completely anecdotal piece of evidence, but there was this headline that I saw from Heizöl 24, which is like a German heating oil website, which did its biggest
good pronunciation, by the way.
Well, yeah, I've got a bit of practice there. 11 years in Austria. It's like how do you say? It's for the end user, basically, to order heating oil. And it did its biggest day of trading ever, I think, a couple of weeks ago. So maybe that's an anecdotal indicator for the way the consumers might be pulling demand forward a little bit at the moment based on price. But it doesn't last.
Yeah, fair enough. So we can dip into kind of more the North Sea fundamentals. We talked a little bit just now about kind of it being a Brent-led story. But how else can we rule out fundamentals being a part of the North Sea piece?
Oh, yeah. I mean, I touched on it already. Maybe talk about it in a few minutes, but it's sort of happening again, and we've been seeing it for the last 4 weeks. Surely the North Sea corrects lower. Surely the North Sea corrects lower. And that's what puts me off saying it again, because we've been saying it for ages. And I would say that, from a sort of FOB premium perspective, 40s looks like a complete outlier. It's more expensive than it's almost ever been since we launched the crude tool relative to sort of key Arbing grades, and sort of Murban and Oman Premia, they're sort of dotting along seasonal or sort of 2019 averages, and MEH in the US is quite weak, whereas 40s is like very strong from a seasonal perspective. So it doesn't look right somehow. Yeah. But I don't want to say again, it's going to correct, because it's not working out for me.
Yeah, fair enough. Okay, so why don't we just have a quick catch up on Iran then? So what's the latest there? And if a deal materializes, what's our best guess scenario for how quickly volumes might actually return to market?
Yeah, I'll go through it very quickly just for time purposes. But it's one of the things I wanted to pick up on because it's a story that is gaining momentum, let's say. It's been simmering in the background for months and months, of course, but for the first time in a long time, there were direct talks between the US and the Iranians, which is a bit of a feat in itself. And there's more due this weekend or this week in Oman, I think. And there's lots of different things going on. It's one of these examples where, Phil, you've said it a few times over the pod the last few months, like escalate to de-escalate. And this is maybe one of the few times where I think it might be true. So there's more sanctions going on. Another teapot was sanctioned this week. There's LPG sanctions happening. I think that's part of a prelude to putting pressure on Iran for a deal. And it looks like both parties are moving towards feeling a bit more diplomatic about this. And yeah, I mean, I don't know how it's going to go. Of course, there's not much point wasting minutes and minutes of it on it. But it looks like there could be a deal in the making in the next few weeks, let's say. A higher chance than there was at any point in the last few months.
Okay, so what do we think about volumes? What's the impact there then?
Yeah, potentially it's quite substantial and relatively fast. I was just trying to look at the historical data. if that's what you want to go by. There's quite a big ramp up from the JCPOA. Once that was enacted, it was a fairly rapid ramp up. And, if you take the sort of 4 million barrels per day mark as the upper potential, then, it's another 500,000 or something, or even more over the next couple of quarters, let's say. So it would be big. It would be big.
Okay, one to watch then. And good job, Phil. I think I was on the podcast actually when you started talking about this quite some time ago, and I think we dismissed it out of hand. So
yeah, I was trying to figure out if that was some kind of backhanded compliment that one of the few times that you actually believe me on this. But
no, I mean, let me clarify. I think the escalate to de-escalate thing is like, do you really think that that's the Trump's modus operandi? Let's say it doesn't strike me as there's really a plan in many of these things.
I think it's a fool's game trying to derive any kind of logical plan out of much of that. But yeah.
Fair enough. Okay, well, look, let's move on to some of the physical markets. Neil, you shared an update kind of this morning on Distillate on US stocks. James is off on holiday this week, so we're passing the baton to you for this one. But look, US Distillate stocks looking as low as I've seen in a considerable few years. So with Bayway restarting, how do we balance domestic recovery with the strong eastbound flows that we've got today?
I don't know if I can answer that question. I mean, one of the things, well, let's just start it off by saying from the Arb perspective, not that much seems to have changed since last week. So it's still the same kind of reasonably bullish setup for Europe, let's say, or, marginally bullish. So a lot of the swing barrels are pointing east still. And the US Gulf MR Arb to Europe is flicking on and off. It's been kind of opening briefly for actually quite some weeks. So nothing too much has changed. The one thing that struck me this morning was the fact that Pad 1 stocks are actually getting pretty low, right? So it's getting to the point, and I have to see if I get my historical data out. I didn't manage to do that this morning, but it's getting to the point where once you go much lower, you start to have some interesting dynamics on heating oil spreads. So you're talking about potential for some basis risk spikes. So for me, that's just one of these things where even though the HOGO is relatively strong already, you probably think it might have some upside if you get one more draw next week, say. That might be something to look for. And yeah, that's all I've really seen from the kind of US perspective. The other thing to point out on Pad 3 is that runs are rising. I was looking at the yields. The Pad 3 middle distillate yields are actually getting pretty big, so they've risen quite a lot. So you get the perspective that actually the sort of TA volumes over the next few weeks might be larger and larger. So that's a kind of bear factor, I guess, for Europe.
Okay, well, I'm very glad that you're still kind of on the relative bullish kind of bandwagon that James continues to be on. But look, let's dive into kind of more of the bullish factors then. Med-Eco change. So how meaningful is the additional like 100 to 200 KBD of demand for MGO in the grand scheme of things when you look at that?
Well, it's one-off, right? So it's always good to think about the one-off things. I guess the 100 to 200, we should probably think about it at the lower end of the scale. That's what I was certainly saying a few weeks ago. Probably the market is overestimating the impact on the 0.5 fuel oil market, which is partly why it's been so weak recently. And therefore it will be overestimating how much diesel demand there will be, or MGO demand, sorry. So it is quite meaningful. It's just one of this list of sort of one-off bullish factors that I've been listing down the last few days. The Eco Zone starting next week. There's possibly this forward demand story from the German heating oil market. The Rhine levels are normalizing, which is generally good for getting product out of ARA into inland. And you've got capacity shutting down in Europe as well, as we know. And then you've got US distillate stocks that are kind of low. So I don't know. I see it still short term. Yeah, I wouldn't want to be necessarily short ICE gas oil spreads at the moment, let's say. Medium term, of course, anything can happen. And I think James is getting quite bearish medium term. And I think that's probably justified at the moment, given all that's going on.
Yeah, fair enough. Bearish factors to add to Distillate?
Yeah, well, turnarounds are going to be over. And that's a global story, of course. And I just think the bearish factors probably start to kick in towards the end of the quarter, where I guess supply is going up and demand is possibly getting weaker, right? And it's just from a that sounds dumb, but
No,
what else? What else would you bet on just now? You still got a very high tariff, a much higher tariff burden on global trade as things stand, and I think the market is right to be concerned about that. And you wouldn't really want to be long sort of like summer gas oil cracks or anything, right?
Yeah, fair enough. So relatively kind of bullish in the immediate term then, given kind of the one-off factors that we've got, but going into summer kind of a little bit pessimistic, kind of distillate then is the summary from that one. Okay, well look, just on that, let's switch back to crude kind of, Neil, while you're on a roll, if that's all right. So look, we've got actually quite a few things to cover here. We've got MEH weakness that you've spoken about, we've got North Sea strength, we've got 40 heading east. So what's the read here on regional crude dynamics? So are these signals of sustained structural trends, or is this just arbitrage noise, do you think?
I don't know the answer. I really don't. Well, there's some bullish factors at the moment. Just taking one step back, turnarounds are ending. Certainly buying in Asia should be moving on post-peak turnarounds. European runs should be rising. US runs are rising. So a seasonal perspective is good for crude. And there's a few other things like, the Chinese imports have been quite strong over the quarter. Set that against what's happening in OPEC and Kazakhstan, things like that. I don't know, maybe it's kind of neutral. What I want to point out again is that most of the physical indicators in crude are not that strong, let's say. Margins are not super healthy, but healthy enough. Middle Eastern spot premiums are not very strong. They're about average. MEH is kind of weak. I think that probably reflects the fact that Asian demand for TI is struggling. Yeah. And we've talked about this kind of on the structural level a few times already, sort of Chinese and Singapore slight changes. And it's really just the North Sea picture, which is confusing. And I'm still, I don't know if it's a bull play or if it's fundamental, but if I had to put my money on it, I would just say it's a kind of bull play rather than justifying kind of 40s premiums that look completely unsustainable. Okay.
Yeah, fair enough. And TI Brent outlook?
Yeah, I wanted to say something on it just because we haven't talked about it in a while. I don't have high conviction. I doubt it can get much wider. So from both legs, as we talked about, Brent spreads look overdone and sort of North Sea looks overdone. I have a low conviction on it narrowing, let's say. And I guess one way of thinking about this is that TI can't be allowed to get very expensive in Asia or Europe at the moment because there does look like there's a surplus of WTI, let's say. Yeah. And then I'm trying to think about the individual components. So we're looking at TD25 likely to remain flat going forward. So there is a bit more vessel supply than normal, but the Suez market's quite strong in the Atlantic, generally speaking. So TD25 is not going to do much in our view. MEH is already weak. And Cushing stocks are not hugely tight. So the only lever is from the Brent side to narrow the TI Brent spread. And there I come back to the whole thing. We've been saying it for weeks. Brent needs to correct, and it kind of doesn't. And, on that basis, it's quite difficult to recommend it again. It might happen, but yeah, I don't know.
Yep, fair enough.
Timing wise.
Yeah, one to keep an eye on kind of over the next couple of weeks then in terms of that market for sure. Okay, well, thank you very much for that. You may now take a break, Neil. And I'm going to switch to Jorge. Why don't we kick off on the light end side? So naphtha time spreads been pretty constructive where LPG has been lagging. So how should we interpret that divergence? And is it a structural shift, do you think?
Yeah, I think, we have talked about a lot about LPG and naphtha in the last podcast. So it would be good to talk about like a review of the main indicators. So yeah, before going to time spreads, I would like to address flat prices. They are trading higher in line with Brent. They are still $100 per metric ton, more or less, for propane and naphtha, below the previous level before the start of the talks about tariffs. But if you look at it in a percentage point of view, it's more or less in line with Brent and TI. So it has been driven mainly by flat prices in crude. The big difference in the market, there are many, but the main one is in time spreads. Right now we are seeing naphtha time spreads skyrocketing in line with another products, like Neil has said, at the beginning, but comparing it with LPG, we have seen a rebound in LPG, but the difference is huge. Naphtha time spreads are higher for the prompt months than before the talks of the tariffs at the beginning of April. So yeah, the main difference is in time spread. Then we have ProNap, the same than cracks and time spread. We saw a very big drop when the retaliation on tariffs from China was announced, and then we have seen a gradual recovery. We are still below the previous level at the beginning of the month, but it's not something very shocking. We have seen ProNap in historical highs, mainly in the east during some parts of the Q1. We have seen a big drop, but it's recovering. And right now we are in the average of the last 10 years. So yeah, it has fall, but it's not a big headline from there. So all in all, the main difference, like if you chart all the different indicators between LPG and Naphtha, the main difference is between time spreads. That in Naphtha they are much more stronger, and I think it matches with the story that we were talking about in the previous podcast. We were talking about two impacts on the lightens market. Long-term one, if petrochemical margins and petrochemical prices are impacted, which would be really bearish for all the lightens, and a short-term one where some demand for LPG could be replaced by Naphtha, and the flat prices in Naphtha and LPG react much more quicker than petrochemical prices like ethylene, propylene, and so on. So we are seeing this healthy environment for Naphtha in the short term, and the main driver and the main indicator is being through time spreads.
Okay, so still short-term bullish Naphtha then in that case. Yep. So we'll keep a view on that. So looking at the physical side, how have the Naphtha Arbs kind of performed over the last, since you were on the pod last?
Yeah, well, we come from Q1, especially end of Q1, March, where we have seen the Arb very open from the west to the east with a very big margin, even through the Cape of Good Hope. And yet we had a very strong cash diffs in Asia, above $20 per metric ton for open spec qualities in Japan and Korea. And then beginning of April, conversation about tariffs, and we saw a very big drop. So $15 per metric ton or more drop in cash diffs in Asia, and rising freight from the west to the east. So this has collapsed the arbitrage. It has been closed for the last 2-3 weeks. And right now we are seeing a recovery. The recovery, cash diffs have improved both in the east and also the FOB values in the west. But the main driver is being the east west. Prompt east west, looking at the continuous contract, is at the highest point in 3 months, almost the highest point in this year. So this is making the Arb more economical. Right now, it keeps close, like from $5 to $10 per metric ton, depending on the Naphtha quality, but it's improving very quickly. And and I think it makes sense if you compare it with the previous history about short-term bullish Naphtha. I mean, if some LPG, propane mainly, has to be compensated by a higher Naphtha demand in the east, they would need to bring product from the west. So I think the outlook is supported for this arbitrage, and I don't expect such a higher margins as in the end of Q1, but for next month we could see the Arb open again and more cargoes going from the west to the east. So the market tightening a little bit more on the physical side.
Okay, thanks very much, Jorge, for that. Let's stick with the light ends of the barrel. And Phil, over to you on gasoline. So look, there's a lot of noise around Bayway Refinery at the minute, the TA Arb and the regional builds. So where should we be watching for the next inflection point in gasoline, do you think?
Yeah, so I think we might have already hit it, to be honest, and that's with the return, which has been slightly confirmed in the latest EIA numbers on the return of Bayway. Obviously, it's a huge facility in a relatively small kind of Pad 1 market there, or at least it takes up a large section of that. So it's been very interesting for the TA Arb in particular. Over the last few months, we saw a kind of earlier than normal pickup in TA Arb flows and having that margin open because of Bayway being closed. And it looks as though if we look at inventory specifically in Pad 1, as though that has kind of almost overdone or almost overcompensated for the lack of supply coming out of Bayway. So Pad 1 inventories have been drawing seasonally, but they haven't been matching the draws of the last few years. So we are at levels Pad 1 gasoline inventories, which are essentially now, still drawing, but a little bit the anomaly out of the US clean products in that they look relatively well supplied. And I think that's going to be a story, at least through the rest of this quarter, in that Pad 1 simply doesn't need to pull as much gasoline as it would maybe not normally do through the second half of Q2. So I think for now, relatively low TA Arb is perfectly justified. If we look a little bit further out, July, August, for example, that is where it starts to look a bit too low again. So I think maybe the pressure that we're seeing on relatively kind of bloated Pad 1 inventories at the moment, or seasonally at least, is being transferred a bit further down the curve, and maybe that's not fully justified. So we've got our kind of refinery Arbs even that are closed in July and August especially. The TA Arb is below 2 cents a gallon in July. It's below 1 cent per gallon for August. So I think there's definite kind of room to the upside there, even especially because TC2 is also weak looking forward to July and August.
Okay, so one to watch further up the curve to see whether that corrects itself then. How are the rest of the markets doing outside of the US?
Yeah, so I feel like a bit of a stuck record over the last few weeks, but ARA components market still not doing anything. So double checking with the brokers, but really the relatively weak premiums that we've been seeing for the last few weeks still haven't really moved. The market seems to be perfectly kind of fine with where they are. There's a lot of talk out there still about gathering bullishness for gasoline, but we haven't yet seen it in physical markets. If we look at kind of the Atlantic Basin as a whole, just do a little roundup on the Arbs, for example, we're in a slightly odd situation that we have Canada, so the Montreal Arb open from ARA rather than the Gulf Coast. It takes a lot of light refit and cheap kind of straight run naphtha, so maybe there's just a lot of that around in ARA at the moment. But I think the most important one, and it feeds into the bit that I'll talk about next in terms of the east of Suez, is that actually the WAF Arb, so the Arb into Nigeria, I think today it's now switched around again, but for the last week or two, it's been open out of the AG on an LR at least, rather than out of ARA. And so that's why kind of earlier this week I was saying that the East-West was too weak and needed to strengthen. That seems to have happened the last day or so that's good. But it was the reason I was saying that was because if we look at Sing 92 spreads in particular, or the Asian side of that east of Suez market, those spreads have been ripping higher, and it's we've got seasonal maintenance peaking in Asia in May, I think, but it also looks as though it was a bit of a pricing center issue in terms of just actual supply into Singapore in terms of that particular blending hub. So imports into Singapore have been weak for a couple of weeks now, exports relatively strong, and so I think that's been driving that particular Sing 92 spread even higher in comparison to, obviously we saw a bit of a rally in EBOB and in RBOB. That's come off maybe today or yesterday, but Sing 92 has continued to move higher. So we haven't really seen much in terms of relative shift in ARB demand out of Singapore. That's hasn't really changed. I think it's more of a supply side issue for the moment, which is why I think it just looked as though the East-West was too weak through May at least. Probably still has a little bit of room to the upside now in terms of kind of that eastern strength versus West, and then it flips back again when you get further into summer, and we should start seeing more of that west of Suez relative strength versus east of Suez once those refineries in the east come back online.
Brilliant. And good call as well at the start of the week on the commentaries. So keep an eye on those going forward. Okay. Well, typically we usually do a roundup where I ask you guys 3 things that you're looking for in your market. I'm going to change it up this week. So I've got 2 questions for you all. So first question, what part of the barrel do we think feels most mispriced to us at the minute? And second question, if you had to pick one spread or one arb to be long in the next few months, what would it be and why? So look, let's start with where we think the mispricing is currently.
Who wants to go first? For me, it's the North Sea crude.
Yeah. Phil, Jorge, on products?
Yeah, for me, from line tens, I would say propane, if there are more news or there is kind of an agreement between US and China on tariffs.
And Phil?
Yeah. Sorry.
Yeah.
Go on.
What was second, Phil? Because the last piece of news that we have coming from our team in Asia points to an exception in ethane flow from US Gulf Coast to China. That's something that we have been reading about it a lot, because it's much easier to replace LPG volume with volume from AG, with Naphtha, than ethane. And the ethane from US, it's harder to find a new home than China. So the last news points on this direction. Let's see if this will be impact only ethane, or if it can be propane can be also included.
Okay, Phil?
I'll steal one from the section that Neil spoke about, actually. I think HOGO is probably the bit that I would be, at least short term, saying is probably the most mispriced at the moment. I think that has some room to the upside, certainly.
Okay. All right. And if you had to pick one spread or one arb to be long in the next few months, and why? Neil, you've got a bit of a tumultuous time on crude here. So
honestly, I thought about your question because you gave it to us about half an hour before we recorded.
Yeah.
I couldn't think of anything. I was thinking about relative value.
Yeah.
Going into the summer, going into a potential recession. Typical ones are sort of gasoline, diesel spreads. What do you guys think about gasoline versus naphtha? Is that an obvious one, particularly if there's a reprieve on ethane? Does naphtha then become a bit like overpriced, so to speak? Or is that too general? Do we want to think more short term?
Well, I think Gasnap has been on an uptrend, but mainly flat for the last couple of weeks. And I think the big rally from naphtha is behind. We have close to 8.5 backwardation in the prompt, so I will not expect like 15 or something like that. So I think like the upside potential is limited. What do you think, Phil?
Yeah, it's a difficult one. Gasnap's already, summer Gasnap's at 115, 120. It has been higher in recent years, but then the gasoline market as a whole maybe doesn't need to be pricing as high as it has. So it really depends on the naphtha side of things. Yeah, I don't have particularly strong conviction, unfortunately. Gasnap, it kind of just feels like it's where it needs to be for now.
Fair enough. Do you have any strong conviction on any of the spreads, Phil?
I do. I mentioned it earlier. So you're luckily in your question you said in the next few months.
Yeah,
so I'm going to take that that little technicality and say that I would be long summer, so long July or August TA arb from here.
Fair enough. Okay. So one to watch on crude. The market still continues to surprise on the bull case that we think that it's doing. So fundamentals technically kind of not forming part of the picture too greatly, but flat price being still kind of highly news related and driven, shall we say. A bit more constructive kind of on naphtha LPG and a little bit kind of on short-term distillate as well. And Phil, very much looking forward to seeing your recommendation for July, August kind of play out on gasoline and TA arb. Anything else from anyone else? If not, we can probably wrap this one up.
I would point out that the May DFL has already fallen from $1.30 yesterday to $1 today, $1. So we're down quite a lot already. So maybe it's happening.
There you go.
Tune in next week where I'll get embarrassed again.
Very much looking forward. I pray this market turns for you, Neil. To be honest, there's a slight kind of, for those that can't see, Neil has got a very big grin on his face. So look, that wraps up this week's conversation. Thanks as always for tuning into Sparta's Market Outlook podcast. So if today's discussion sparked any new trade ideas or helped clarify some of the chaos in the market, we'd love to hear from you. So drop us a line, please share the pod, and don't forget to subscribe so you never miss us, and especially next week's kind of crude update. So until next time, stay sharp, stay curious, and keep your positions nimble by the sounds of it. Thanks a lot.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.